There are a couple of common ways to calculate levered free cash flow, often starting from different points in a company's financial statements. One frequently used method begins with earnings before interest, taxes, depreciation, and amortization, commonly known as EBITDA. EBITDA is a measure of a company's operating profitability before considering the effects of interest expenses, income taxes, depreciation, and amortization. To arrive at levered free cash flow from EBITDA, we need to account for the cash flows related to the company's working capital, its investments in long-term assets, and its debt obligations. Specifically, we subtract the change in net working capital, which reflects the difference between a company's current assets and its current liabilities. We also subtract capital expenditures, often referred to as CapEx, which represents the investments the company makes in assets like property, plant, and equipment. Finally, we subtract the mandatory debt payments, which include both the principal and interest paid on the company's debt. So, the formula for levered free cash flow using this approach can be stated as levered free cash flow equals earnings before interest, taxes, depreciation, and amortization minus the change in net working capital minus capital expenditures minus debt repayments. Generally, a higher net income will lead to a higher levered free cash flow, as it signifies greater profitability after all costs, including interest and taxes, have been covered. Depreciation and amortization are non-cash charges, so adding them back recognizes that these accounting deductions didn't actually involve a cash outflow, thus increasing the available cash flow. The change in net working capital can either increase or decrease levered free cash flow. An increase in net working capital, for example, if its customers are taking longer to pay, reduces levered free cash flow. Conversely, a decrease in net working capital, perhaps due to faster customer payments, represents a cash inflow and increases levered free cash flow. Capital expenditures are investments in the company's long-term assets, and these represent actual cash outflows, so they reduce levered free cash flow. Finally, debt payments, or more accurately, net borrowing, have a direct impact. Mandatory debt repayments are a cash outflow, thus reducing levered free cash flow. However, if a company borrows more money than it repays, positive net borrowing, this represents a cash inflow in the current period, which would increase levered free cash flow in that specific period. It's important to remember, though, that while borrowing can temporarily boost levered free cash flow, the obligation to repay this debt in the future, along with the associated interest expenses, will negatively impact future levered free cash flow. Therefore, it is essential to analyze levered free cash flow trends over time rather than relying on a single period's figure. To learn more about free cash flow, watch our other videos.